Hey everybody, what's up? Time for commentary. I want to talk a little bit about oil and also about gold. I'm going to start off with oil. One of the interesting developments I have noticed when examining that weekly EIA petroleum status report is the surge in crude oil exports. Okay, in the latest report, which came out yesterday, up again to a record high. Very, very strong. 3 million barrels a day. Now, what's interesting is that exports had begun to throttle back. They had started to slow down as the dollar climbed. And that's understandable, I guess, because a higher dollar makes exports more expensive. But then all of a sudden, exports started to really take off again. And that coincided with renewed and I should say very aggressive threats by Trump against China, threatening to impose tariffs on 200 billion worth of Chinese imports and all that stuff. You remember this rhetoric last week. It sent the markets into a tizzy. And since then, we saw a very significant pickup in crude oil exports. Now, if you go back a ways to May, I think it was May, when I said that China, back at that time, said it was going to curtail imports of Saudi crude because the price was too high. And I said at the time that China, as the world's largest crude importer, is a price setter, all right? And in that capacity, it has the ability to basically establish price. Now, you may recall at that time, we got out of our long oil position, which we really have been long since $30. It ran up to 72. I said, that's it. Let's get out. A lot of hedge funds were still in. It was very, very bullish. If you read all the market commentary, they were all bullish. And I said, nuh-uh, China's setting price up here. They're balking at buying this higher priced crude. And sure enough, what happened? You had the sell-off down to 63.40. Now, we got back in at 64 bucks, and the price has since run up. But again, the interesting thing that has emerged is since those very aggressive threats that Trump levied against China, we have seen a very significant increase in U.S. crude exports. Now, my interpretation of this is that China is now trying to narrow its trade surplus with the United States by buying U.S. oil. In other words, it is attempting to placate Trump's demands, to placate Trump, to make him happy, to try to bring down its trade surplus. The interesting thing about this is now the whole rationale behind China's buying of oil has shifted from energy needs, real energy needs, to narrowing the trade surplus. And under that scenario, if I'm right, and I don't know if it's China buying, I'm making a calculated guess here because it came right after those threats. Under that scenario, where it's not an activity based on price or domestic energy consumption needs, but basically it's based on a goal of narrowing the trade surplus, China could buy this oil all the way up to the moon. I mean, it could really set prices way, way higher. And that's why I think that's why you're seeing this rally. It is really just relentless, and it could continue like this simply because we don't know what China's ultimate goal is here. How much do they want to narrow the trade surplus, and how much oil are they willing to buy to do that? I mean, they have a ton of money, a ton of dollars, so they're definitely capable of pushing oil way, way up. So you have that going on, which is a very interesting phenomenon. I don't think anybody's talking about that. It almost removes an upside target for oil. But again, I am not privy to their, what their strategies are. I'm not sitting in a room with the guys who decide how much they're going to shrink the trade surplus, if that is indeed their motivation here. but this thing could really start to get out of hand, number one. Number two, on gold, I will say this unequivocally, that this sell-off, and today we're in the 1247 as of this video, this is probably the greatest bullish setup for the next couple of years. This sell-off, which has been driven by liquidation by speculators, and now more recently, speculators getting net short the gold market, a position they have not had since the last over 2 years, about 28 months. What's interesting that alongside this, as this has been happening, gold producers who are natural sellers of futures, they have been net buyers of futures for months and months and months and months. So while the speculators have been liquidating their position, gold producers who own the physical, right? That's their business. And so they're ordinarily net sellers. They have been net buyers of gold almost, for a year now. But it's really accelerated in the last few weeks. So this is an extraordinary setup. I think we will look back at this in a year, 2 years from now and say, wow, 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 wow. This is like the $1,040 an ounce back in whatever it was, December of 2015, right before the Fed started to raise interest rates. And finally, let me tie the two things together here. If oil goes up on this Chinese buying, and it's quite possible that it's not only going to go up, but it could go up like a lot beyond anyone's most optimistic forecast, gold is going to follow oil. It always does. So even though it doesn't look like that's happening right now, it is absorbing a lot of speculative selling right now. Speculators building a short position, liquidating long position. That's all. That's going to run its course, and eventually you're going to see this gold snap right back to where oil trading higher. And by the way, I would just throw this in addition to all this, when this scenario comes together, and I feel pretty confident that it will, the Fed's rate hike campaign is going to go into overdrive because oil is going to power all the inflation indicators higher. And everybody who thinks that the 10-year Treasury, that bond yields have topped out, forget about it. Nowhere near topping out. All right, that's my update. Maybe see you guys later. Bye-bye.